Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have back CEO Bill Crossland from Thermal Energy International. Thermal Energy trades on the TSX Venture Exchange under the symbol TMG, and it also trades on the OTC under TMGEF. The company is currently trading at 12 cents with roughly 164 million shares outstanding, or about a $20 million market cap. I'd now like to hand it over to Paul Andriola.
Hey, thanks a lot, Trevor. Yeah, great to have Bill back. Bill, we noticed you put out a press release here talking about a record backlog or record order book, I think it's called. Clearly you guys have been busy over the last 6 months or so, and lots is happening. So I think it's a great time to catch up again and really find out what's going on with the business, get caught up, and ideally give a sense of what you think the outlook is. So Bill, welcome. And, sort of before we get into too many things, why don't you remind everybody what thermal energy is all about? And I understand you got a pitch deck, so I'll just turn it over to you and let you have it.
Great. Thank you, Trevor. Thank you, Paul. Thanks for having me back. And it has been a very exciting 6 months anyways. I mean, we went through some difficult times for sure during the pandemic, but we knew the market would come back stronger than ever. We didn't think it would take as long as it did, but boy, it seems to be back strongly now. And I'm so pleased to be able to tell everyone all about it. But as we mentioned, I'll tell you a little bit about the business just to let people know and to refresh other people's minds if they've already heard it. But Thermal Energy International is a proven provider of energy and carbon emission reduction solutions to some of the world's largest companies. We focus on very large multinationals, and that's the majority of our customer base is very large multinational companies that have facilities all over the world. Our forward-looking statement caution. So we believe a compelling investment opportunity right now, and 3 main reasons why. Number one, it's a very fast-growing global market. Really is a global market with very strong fundamentals, and those fundamentals have gotten much stronger over the last sort of 2 years, since the pandemic began. The business case for energy and carbon emission reduction solutions, which is what we do, has quite frankly never ever been better, and that's really driven by 3 things: dramatically increased cost of energy, dramatically increased cost of carbon, and new aggressive carbon emission reduction targets from virtually every major company and every major country in the world are now on board to aggressively reducing their carbon. So that's the first thing. But even before that, we had established ourselves with a proven track record of growth and profitability. And now this was pre-pandemic, and so that that line might be getting a little bit stale, but I'm going to tell you exactly what happened to us during the pandemic. But right up to the point of the pandemic, so right up to February 29th, 2020, we had a 5-year compound annual growth rate on revenue of more than 30%. We had annual revenues of $25 million, EBITDA of $3 million, and annual net income for those 12 months of almost $2 million. So proven our ability to grow the business and grow profitability. But despite the strong market, despite the proven track record, right now we believe it's a compelling valuation investment opportunity. And why? Because as Paul and Trevor alluded to, year-to-date order intake is well ahead of where it was pre-pandemic. So for the first 6 months of this year, but not only that, on an LTM basis, I mean, the strength really has been in the last 6 months, but already on an LTM basis, our order intake exceeds our pandemic high. Back in 2019, we had about $22.7 million of orders in for that fiscal year. That's what drove us to $25 million in revenue in 2020. And we're ahead of that now for the last 12 months for the first time since 2019, which is really exciting. So we have a record number of projects in development with customers. So we believe, based on that, we are poised to continue and exceed our strong track record of growth and profitability. And if you believe it, it's a pretty compelling valuation. Because if you believe, as I do, that we're going to get back to our pre-COVID levels of performance, we're only trading at about 0.9 times enterprise value to revenue. But even on an LTM basis, even with the impact of the pandemic, it's a 1.4 times revenue. So a pretty strong, compelling valuation given that growth profile. So And when we talk about the market, first of all, it's important for everybody to realize what we do is we help our customers reduce their energy use and therefore reduce their carbon emission. Most of the time when people think of energy efficiency, they think electricity. And there's a good reason for that. You know, electricity is more obvious. Electricity on a residential or a commercial building, electricity is about 50% of the energy you use. And thermal energy, usually natural gas, is the other 50%. But in the industrial market where we operate, 90% of energy use is thermal energy. And on the industrial side, it's only about 50% on average efficient. So we have lots of opportunity to help our customers. And most of our customers will tell us that they've already reduced their carbon. They've met their carbon emission reduction targets when it comes to electricity. That's easy. You know, it's on their grid. They can buy green power. They can put some renewable energy, put some solar panels up. The thermal side is much more challenging, and that's where they need assistance. And that's 90% of their energy use. So improving thermal energy efficiency, what we do, is by far the fastest, cheapest, and easiest and most significant way for our customers to reduce their energy and carbon use. So that's what sets up the market. But also, in the last 24 months, it's not really 12, it's the last 24 months, we've had dramatically increased energy costs. It's very volatile, as you can see on the right side. You know, there was times they were even higher, they've come down, but they're still significantly higher than they were. In Europe, they're about 300 to 400% higher than the long-term averages out in, 2019 and 2020. That's when we were growing the business at 31%, and energy prices are now 400% higher than that. So, if the paybacks, if our projects had good returns then, they have even better returns now. North America is up sort of 50 to 100%. So again, the paybacks are that much better. And these prices are not expected to go down. All forecasts are for them to stay at these levels or increase slightly. And then on top of that, you've got increasing costs of carbon in many markets. So the EU market, as an example, carbon credits there are up about 300%. In the last 2 years. They're currently at about $120 Canadian a ton when you convert it. Canadian carbon taxes recently increased from $50 a ton to $65. They'll be going up to $170 a ton. And just for your information, at about $100 Canadian a ton of carbon, we look back at a number of past projects that we had done, and on average, that improved the payback on those returns by about 50%. So $100 a ton has a meaningful impact for our customers. So you've got that, both the cost of carbon and the cost of energy causing dramatic improvements in the return on investments for our customers. And then finally, the increased carbon reduction targets. Most companies are sort of targeting 40 to 75% reduction by 2030, driving towards net zero by 2050. So we got lots of opportunity for the next 20, 30 years. And this is the most exciting slide here. Just to, these first two charts, that's the executive summary. This is almost all you need to know. This is our order intake for the first 6 months of this fiscal year. So you can see that it's, it was flat for a number of years during the pandemic. And our year end is May, so this is sort of June to November, the floodgates opened, and it was really after the summer ended. It was sort of from August on. We're now at $18 million for 6 months in orders received. And as a result, you can see here on the slide right beside it that on an LTM basis, we're now exceeding that level of orders that we had. That $22.7 million of orders in 2019 that drove us to the $25 million in revenue in 2020. So that's the exciting part. That's from our standpoint. So what, how, where, and with who? Tell you a little bit more about what we do for those that don't know. What we do, we design, engineer, and deliver energy and carbon reduction solutions for major multinational customers. It's a sole source delivery model. We're rarely involved in competitive pitches. That's because we develop these projects in partnership with the customer. We have something proprietary. They can't really bid it out. So they have to, we develop partnerships with our customers to develop the projects. And all of our projects use our unique suite of proprietary technologies. And over the last few years, we've been actively increasing our portfolio so that regardless of what our customer needs, and regardless of the application or the situation at that site, we have the technology that meets their needs. And we deliver those solutions with a flexible delivery approach. There's two main ways that we deliver it. And the difference in these two delivery approaches really showed up during the pandemic, as I'll show you in a minute. Prior to the pandemic, about 70% of our revenue was turnkey projects, where we did everything for the customer. We came to them with the solution, we would design it, engineer it, and install it, and start it up for them. A turnkey solution, single point of responsibility, and that was the majority of our business. The other 30% was when the customer just wanted the technology as maybe a simpler application, a simpler installation. They knew how to install it themselves. They were just going to buy the technology and install it. That was about 30% of our business. But there's significant difference in these two delivery models. Turnkey projects has about a 2 to 3 year sales cycle. The reason is they're big, large, often multi-million-dollar projects. Most of our projects are between $1 and $3 million. And you have to sync up not only with their capital budgeting cycle, but their operating cycle to do the installation. So usually there's about a 3 to 12 month sales cycle to get what we call a project development agreement. And usually the way that works is we go and we pitch a customer with an idea based on a little bit of engineering work, based on what we've seen at their plant so far. We come to them and say, look, we think we can save you $1 million on your energy bill, and it's going to cost you $2.5 million to do it. Is that something you're interested in? And they say, well, that sounds pretty good. Can you do that for us? And we'll say, well, we haven't done all the detailed engineering yet, but I'll tell you what, you sign a project development agreement with us. We'll do all the detailed engineering in order to deliver to you a fixed price, guaranteed performance contract. And if it meets the criteria, say a 2.5 year payback, $1 million savings, 2.5 year, $2.5 million cost, then you either have to do the project with us or you have to pay us X dollars. So we know they're committed. And that usually takes once we get that project development agreement, it usually takes 6 to 12 months to gather all the data, flesh out the proposal, do the engineering, and come back to them with a final project order, and then actually get the order from them. And then once we get the order, it's sort of 12 months to complete the project and revenue it. You contrast that with custom equipment, where we can usually sell it in 3 to 6 months, and as soon as we ship it, we get the revenue, right? As soon as we ship the piece of equipment, we get the revenue. So it's got an order, a sales cycle to revenue of 9 months to a year versus 2 to 3 years for turnkey. So there's far less travel, far less collaboration with the customer on the custom equipment, and that really came out during the pandemic. When you had site lockdowns and travel restrictions. Mm-hmm. So where do we do it? So you can see here, our strategic focus is North America and Europe. These little black dots are where we have sales or engineers, primarily salespeople on the ground. The yellow pegs are where we have engineering and administrative offices. So engineering and administrative offices in Canada, the US, and the UK, and feet on the ground, sales and engineers in Canada, the US, the UK, Ireland, France, Germany, Poland, and Italy. And throughout the pandemic, we continued to add people to grow our team. Added people in Germany and France during that time. Okay, and with who? I guess this is basically so extensive multinational client base, and again, that's by design. That we work with these customers, and the reason is there's 2 reasons. Number one, we're looking for large energy intensive industrial sites where they use a lot of energy. So if a rough rule of thumb, we can save them 20 to 30% of their energy bill. So we're looking for sites that have at least $1 million, spending at least $1 million or more. It tends to be the large multinational companies that have the large industrial sites. And so if we can save them a lot of money at a site, we can do a nice big project for them. The other reason is these guys have hundreds of sites around the world. So what we want to do is once we sell them at one site, one product at one site, we want to sell multiple solutions at multiple sites. Over the last 4 years, about 60% of our orders have come from our top 10 corporate key accounts. We've partially penetrated about 100 of these customers' sites in 15 countries. And initially people would say, geez, 100 sites, sounds like you're almost done. But these 10 key corporate accounts have 1,000 sites worldwide, average about 100 sites each. And so we're less than 5% penetration, even with our established customer base. And we're adding to that customer base all the time. And then across the bottom is really just examples of different projects that we've done over the last few years to really just show you, the different sectors. That was dairy, brewing, meat processing, another brewer, hospital, another dairy, snack food, pet food, and food ingredients. You can see that the value is anywhere from $1 million to 2.5 million. There's one 2.8. The payback is sort of anywhere from 1 year to 4 years. And the location is diversified between Europe and North America. Okay, so at the end of the day, what makes us unique? It's really two things. It's our unique suite of proprietary products and our ability to offer turnkey solutions: design, engineer, deliver, train, and install, with very strong paybacks on our projects, and our strong relationships with multinational customers. And as a result, our customers keep coming back, quite simply because we're the quickest, easiest way to get projects done on time, on budget, with guaranteed performance. That's why we have such a huge repeat business. So about 80% of our business is repeat orders from our existing customers. So just to tell you a little bit more about the fast growing market with very strong fundamentals. We talked to you, I mentioned the increase in energy costs. That's obvious, right? It's obvious why that would have a significant impact on our business. With energy, if energy prices double, that cuts the payback in half. So what was a 5-year payback before becomes a 2.5-year payback. So, customers or projects that previously didn't meet their investment hurdles are now back on the table. And customers are coming to us looking to reduce their energy costs now. They don't want to wait for future technology. They want to see what they can do right now. And that's where we come in. Oh, sorry. But to give you a couple of examples on the increased cost of carbon. So there's two different examples. One was the first one's a European dairy company. It was about a $900,000 project. The energy savings were about $300,000. So it was about a 3-year payback just from energy savings alone. But in this market, where this country, where this company was, this site was, because every country is slightly different. They provided the customer an upfront credit based on how many tons of carbon they were going to reduce, one-time upfront credit, and that amounted to $400,000. So the net cost to the customer reduced from $900,000 to $500,000, and the payback went from 3 years to 1.7 years as a result of the carbon savings. Another one was a North American cereal producer. This was about a $1.4 million turnkey project. We were reducing their carbon emissions by 20%. They were in a market where they believed the value of the carbon was going to continue to go up, and they thought by 2030 the annual carbon reduction would be worth $200,000 annually to them, and that's why it made sense. So here I've said again, at about $100 Canadian a ton, that improves the average return on investment for our customers by about 50%. Okay, reducing carbon targets. We talked about this before. I mean, this is, virtually every country and every company. I've got listed down a couple of examples there. There's 3,000 businesses and financial institutions have adopted the Science-Based Targets Initiative. That's really sort of to drive their carbon emissions down to meet the IPCC's target. So PepsiCo is an example. Their target is 75% by 2030. Colgate-Palmolive 50% by 2030. Pfizer 60 to 80% by 2050. Okay, so now let's get into the results a little bit. Just the results that we drove, that 31% compound annual growth rate was driven by the same successful growth strategy we have in place now. If it ain't broke, don't fix it. Really had 3 pillars. It was leverage our existing high quality customer base. We want to sell more solutions to more sites for those customers. We want to increase our portfolio of complementary products, and we have been doing that so that we can sell more solutions to more sites. And we want to grow our team and our global presence so that we have a presence in different markets. And we want to do all of that both organically and through acquisitions, and we have. We believe we still, we've made a couple of acquisitions. 2018, we acquired Boiler Room. 2021, we acquired the technologies of SOFEM Technologies. Despite that, most of our growth has been organic, which is great to see. We think we still have a very unique acquisition platform with established sales and engineering teams in both North America and Europe, and a direct relationship with a growing list of multinational customers, and still a strong balance sheet despite the pandemic. So that growth strategy was what drove these results that I talked to you about. So you can see there over 5 years, the 31% compound annual growth rate right up to 2020 at $24 million. Then you saw it dip. Our year end is May. So fiscal 2020 included 1 quarter of the pandemic. And that was a tough quarter. That was March, April, May of 2020. Basically, revenue was less, about 60%, dropped by 60% in that quarter, gradually came back. So the pandemic had a dramatic impact, as I'll show you in a minute, on turnkey projects, but because of the site lockdowns and travel restrictions, but custom equipment continued to grow throughout the pandemic. And despite the pandemic, you can see here, we maintained our profitability until very recently. And we continued to invest in growth by investing in the team and training. We used some of the downtime to train the team. We wanted to make sure we had a solid team. It took us a long time. We've got a very technical team. We didn't want to lose them. We knew the market was going to come back. And we wanted to make sure we were ready to hit the ground running. And we were also investing in acquisitions and architecture for growth throughout the pandemic. More recently, we started to lose some money because about a year ago, we started to invest more strategically and more aggressively for growth. During the pandemic, all discretionary expenses were put on hold. We all took voluntary salary cuts. That had to all end about a year ago as we started ramping up for the market to open, and there was an end of government support program. So that loss was not unexpected. We knew it was going to happen. It was strategic. We wanted it to happen anyways. And this is basically what you can see is basically the turnkey project. So you can see all the revenue decline since our record results of $25 million revenue has come from turnkey projects, whereas custom equipment, after a little bit of a dip in 2020, has continued to come up and is up even stronger now, as I'll show you in a minute. So bottom line is custom equipment continued to perform very well. Turnkey solutions is where the challenges was during the pandemic because of the pandemic. So where are we now? What's the outlook? This is the exciting part. So custom equipment, well, custom equipment orders continued to grow, as you can see here, some pretty steady growth. This is the first 6 months of each of the last 5 years. But this year, like I said, for the first 6 months this year, the floodgates have opened. We're up significantly, more than double what we were last year. So that's pretty exciting. So our revenue is already ahead of the pre-pandemic highs, and now our order intake is significantly, like 200% ahead of the pre-pandemic. But what about turnkey? So finally, turnkey is also turning the corner. And again, this is just for the first 6 months. You can see we're almost $8 million. So revenue hasn't rebounded yet because as we saw up front, it's about a 2 to 3 year sales cycle. And it's about 12 months after we get the order before we start to revenue. So turnkey revenue hasn't rebounded yet, but the orders are in and are coming back stronger. They're already up. They're 66% higher than they were back in 2019 when we drove to $25 million. But even more exciting than that is the project development agreements. I mentioned that project development agreements are a regular precursor to getting a full turnkey order. And those are up significantly. We're almost twice what we were, more than twice what we were back in 2019, twice what we were last year. On an on a year-to-date basis, we've signed 11 projects. So we got 11 new projects in development with customers. The last 12 months, we signed 19 project development agreements with customers, by far the highest it's ever been. And so this is just to sum it up, you can see our year-to-date total order intake almost tripled last year, 150% higher. This is just a list of those orders that you can see. I told you it started right as soon as the summer was over. And those are all the order-related press releases we've had since September. And this just sort of highlights again that our year LTM, last 12 months order intake, now exceeds the pre-pandemic high. So we believe we're in a strong position to resume our growth rate and revenue levels from the pre-pandemic. So compelling valuation investment opportunity. Like I said, again, to sum up, 6-month year-to-date order intake, 150% higher. LTM order intake already exceeds pre-pandemic. We're poised to continue our strong track record of growth and profitability at 0.9 times enterprise value to pre-COVID revenues. It's a pretty attractive, compelling multiple. That's the stock chart. You can see here when the volume is increased, that's every time we start doing a little bit And you know what that is? That's when I've been speaking with Trevor and Paul's groups there. When you see that volume increase, it is. It's January, February, right? No, that's
Yeah.
that's also when we start to ramp up our investor relations. We had a couple of false starts during the pandemic, where we thought the pandemic was over and we ramped it up, but we're starting again now. You can see recent prices at 12 cents. Market cap almost $20 million, enterprise value about, just over 21 because we've got a little bit of debt, but that's about a 0.9 times enterprise value to pre-pandemic revenue. About 10% is owned by management directors, 4%, I own 4%. Almost all of that, essentially probably 95% of it has been shares that I've purchased in the open market with my own money. And I'm probably the second largest shareholder now, because I believe in the company. I'm very excited about it. And I think that's about it. Yeah. So why invest now? Sum up, the business case for energy and carbon emission reduction solutions never been better. A proven company with an established track record, compelling valuation investment opportunity right now because the current valuation does not reflect the significant market improvements, proven track record, or record order intake levels. Thank you.
Fantastic,
Happy to
Bill.
answer questions.
That's awesome. That's perfect. And we did get some questions in from somebody, and we'll just dive right into them.
Yep.
So you did touch on and gave some details around the order intake and sort of the process of these orders and turning into revenue. But let's break it down a little bit more for everybody. This $18 million roughly in order intake right now. How long do you think it takes before that shows up revenue wise? And how long? I mean, some of these projects are probably longer than others. How long does it take to sort of execute on these orders?
Yeah, so that's a mix. If it's roughly $10 million in custom equipment and $8 million in turnkey, the custom equipment is about 3 to 6 months. So we revenue usually 3 to 6 months after getting the order. The turnkeys is more like 6 to 12 months, because the turnkey, like as I mentioned earlier, with the custom equipment, we just have to manufacture as soon as we ship the product, we can revenue it. With the turnkey, the big turnkey projects, it's based on a percent complete basis, and the accounting rules are the percent complete is determined by the percent of costs incurred. Most of the costs in these big turnkey projects are rear end loaded. That's when we have to pay for the equipment. That's when we have to pay for the installation. So all the engineering and pre-site work up front, there's not much cost to that. So usually just not much revenue comes in for the first 6 months of those. So that's sort of a guide. So for sum up, 3 to 6 months for custom equipment, 6 to 12 months for turnkey.
So basically what I'm hearing is that within the next 12 months that the majority of that should turn into to revenue, right? Yeah. Okay.
Yeah.
Perfect. And I may have missed it here, but margin wise, like what kind of margins does that sort of look like? What gross margins do you guys get off of that kind of blend?
Yeah, I mean, off that sort of blend, it'll be around in the 40s. That's usually where our margin is. I mean, it's, quite frankly, the turnkey projects have a lower margin and the custom equipment has a higher margin. And that makes sense because the custom equipment is all proprietary. So we get a higher margin on that. The turnkey, it's, a proprietary engineering, but, how much can we charge for installation? That's, those are contractors. So that's a less high value added margin. So that tends to be a bit lower. That might be in the 30s, whereas the custom equipment might be in the 50s. It averages out in the 40s.
Now, I mean, it's quite an inflection that you've gone through here over the last little while, and this kind of increase in orders. I mean, is it really just energy? And I imagine Europe is dealing with a different energy crisis than we are here in North America. Is it just energy and carbon, or is there something else we're missing that's driving this type of?
It's energy, carbon, and probably because of energy prices, the carbon emission reduction targets. Right, our customers are taking that much more seriously. Not only because energy prices are high and carbon prices are high, but because everybody now is behind this goal to reduce carbon emissions. So, if you're selling to a consumer goods company, they have advertised their carbon emission reduction targets to their consumers, to their customers and to their shareholders, and they have to deliver. And so, that cereal company and that North American cereal company, that project was about a 10-year payback, as it turned out. We had never seen that before. What we're seeing now is that it used to be they had a capital pool. Every year they had a certain pool of capital to invest in capital expenditures, but they didn't really divide that pool of capital up. They had to decide, did they want to reduce energy, or did they want to put a new line in, or want to make some improvements to the plant? And what we're seeing more and more now is they have dedicated pools of capital that are only for energy and carbon emission reduction targets, and the return requirements on those pools of capital are not anywhere as stringent as the typical. So they are very serious about reducing it. So, I had been, as a management team, I've been, telling boards and shareholders that I saw the market building for the last 2 years. And I didn't think, to be honest, I didn't think it would take 2 years for it to come back. But so it's not like all of a sudden it just happened. We had seen it building and building and building, and we knew it was going to bust open. It just happened to, bust open at the same time.
Yeah. So I'm back to what you just said. I guess part of the reason is also public relations. It sounds like some of these companies are doing this as just goodwill and PR. So there's that side of it as well.
Yeah, absolutely. That, like I said, you go on any major consumer products company's website, and they have it all over what their targets are. They have to meet them. They can't, because everybody knows what those targets are. So they're very serious about meeting those targets.
Now, let's talk a bit about your balance sheet. You said you've got about, I think, $1 million in net debt, if I remember correctly.
That's right.
Or something like that.
Yeah, a little over $1 million.
Yeah. Now, as far as working capital and the things you need to be able to continue to grow the business, do you have what you need, or do you think you have to go out and raise more money to grow faster, or to do whatever you need to do?
Yeah, we have what we need to continue growing. I mean, we have what we need to deliver the $18 million. If we think, would we consider? I've always said, historically, I said I would not raise capital unless I had an accretive use for it. I'm not going to raise capital to fund losses. I'm a shareholder and I'm value driven. But if we see some opportunities to grow even quicker, and we need some capital to do that, if there was the right price, we might consider it. But we have what we need to deliver to get us back to the levels we were at before. That's for sure.
And do you ever look?
$18 million. I hate to do it. You annualize that. That's $36 million worth of revenue, right? 18 million in 6 months. Now, I'm not saying we're going to do that, because that was an exceptionally strong 6 months, and our business is lumpy, but we can easily get back to where we were before.
Yeah. And, you expect that you're going to generate a significant amount of cash flow from that. What would you do with excess cash if you had it right now, outside of an acquisition? Is there anything else you do?
I would reinvest it in the business, and that's always, we can grow the business with our cash flow, and that's generally what we do and what we've historically done. So we would just, hire more people, make an acquisition or two. So just reinvest it. We have done, though, Paul, we have in the past bought back shares. So we have, done normal course issuer bid in the past. I see the market so compelling right now that that's probably not the best use of funds. So we would just invest it to grow even faster.
Okay. Yeah. No, that's certainly good to hear. You see better return on growing the business. So that's proper capital allocation. Okay, I've got a question here. It says you segregate revenue by geography on your financial statement. Revenues from Ottawa and from Bristol. Could you elaborate a little bit more, or elaborate a bit why you show geographic breakdown? What's the significance of the geographic breakdown?
There isn't really, but it's required by accounting standards.
There you go.
So we really treat the whole business as one global business. Honestly, we're not too fussed by where the revenue comes from, but so the only reason we do that is because we're required. We have to. It's not a business decision. Yeah,
no, I gotcha. I mean, we're hearing so much about the energy issues in Europe. Mostly sort of natural gas related. Are you finding that's where the low-hanging fruit is right now, or is it just everywhere?
Sorry, Paul. That's where what is?
Well, it's sort of the low-hanging fruit. Like, is it a bit of an easier sell? I imagine it would if gas is like 3 times the price it is in North America.
Yeah, It's not only that, it's not only gas is 3 times the price, it's also they have their carbon markets, so they have an expensive, they have, all those countries have more aggressive targets. So it's all of the above. So Europe is our focus for growth for sure. Having said that, North America is held up very nicely there. So North America continues to grow, but where we're going to invest more resources, we're probably going to invest more resources in Europe. Put more people in France, Germany, Spain.
Yeah. And as far as capacity, like your ability to deliver, do you have what you need right now, whether it's manpower or, space or whatever it takes, what does that look like, and what does it potentially look like going forward? If all of a sudden you do double your business, your order intake, what do you have to do to be able to make sure you deliver?
It's mostly people.
Okay.
Yeah, it's mostly people. So we're looking at that very carefully and trying to get ahead of the curve. We haven't reduced our staff. In fact, we've grown a little bit from, back pre-pandemic when we delivered $25 million in revenue. We actually have 1 or 2 more people now than we did back then. So we're pretty comfortable now to exceed those levels. But we're looking to the future. So it's adding people.
And then I've got a question here about competition. And clearly, if the market's starting to grow for you, it's growing in general. What's the competitive landscape look like? Why you better than some of your competitors?
Yeah, I mean, the technologies that we have, they are unique and they're proprietary. There's other people that might have something that does something similar, but so far we've never found anyone that sells the equipment and does the full turnkey project. Usually it's one or the other. And that's really why our customers like us. Is, like I said, we're the quickest and easiest. And it's even more important now because, the sustainability guys and the energy, VP energy, the team of people that's tasked with reducing their energy and their carbon, they have so much to do now. They're more than happy to have someone come in and develop the project and guarantee the performance. So we still really don't see much competition. Like I said, it's a sole source delivery model. When we go to customers, they're not, occasionally they're coming to us, but generally we're going to them because if it's a new customer, they don't know the technology exists. They don't know they have the opportunity to save the energy. We're going and pitching them on it, and selling them on our capabilities. And then once we've done one or 2 projects with them, it becomes, every project you do gets a bit easier. But it's really that partnership we have to develop with our customers so that they trust us and we execute projects for them.
Yeah, you sort of answered my next question, was just that it's now I understand that you've got a lot of big customers where you've got several projects there, and then it's easier to just sort of go in and sell them on their other facilities. But just that, are you getting people that are coming to you sort of saying, hey, we've heard about what you guys are doing and we're interested, or is it still knocking on new doors here to try to get business?
We're getting it's still mostly knocking on doors because people don't, what we're getting, we've been around long enough now. I mean, I've been at this 10 years. And so, what happens is we establish a product champion at our customers, somebody that loves us and will take us at the corporate level so that he can go from site to site and tell us what site to go to. So a lot of our, some of the recent growth has come when those guys move to a different company. So that's about the only time that somebody comes to us. It's they've heard about us, they used us at a previous company. So most of it is still us going after them, but it's pretty easy for us to identify. We know the industries that we're good at. Our sales and engineers, they can look at a site and probably give a pretty good idea. If they know what's going on in the site, they know whether we can save them energy. We have a pretty good idea of who needs our services. Gotcha. But it's still mostly us introducing it. Gotcha. The difference is the people that, and this is really a difference in the last 12 months, that the people that know about our product are pushing much more so than they used to. So we announced a $2.8 million project for a brewing company in Europe in the fall. And that was a case where the company came to us, they knew us, they came to us, they said, we want you to do a project for us. they gave us an order after, on the first call, basically a couple of weeks later, they gave us an order for a project development agreement. They said they wanted to get it done as soon as possible. They wanted to start saving the energy as soon as they possibly could. They said, as soon as you get it done, let us know. We'll give you the order probably a week after that. So we got it done. We delivered the proposal. It was basically in line with what they thought. They gave us an order, and so that one turned around. Whereas usually it's sort of 6 to 12 months from PDA to order, that was less than 2 months, I think. And then the order was right away. So that one will probably go from pitch to revenue in 12 months. And that's what we're seeing, more of it, where companies say, do it quick.
Right. So it sounds like the sales process is shrinking, and a few of the other things are shrinking along with it.
Based on two things, based on familiarity and based on need, right? Because the projects are that much more compelling.
Exactly. Yeah. Let's talk about supply chain and logistics. You guys still, so many businesses were facing so many critical issues over the last couple of years. How's that looking for you guys right now?
It's getting a little bit better, but it was tough. If you'll look at our custom equipment, we are, while the orders are up, and I can't remember the percentages, but the orders over the last couple of years are up much more than the revenue. And that's because we couldn't get the stainless steel, or we couldn't get this, but everybody's in the same boat, and we've seen prices start to ease now. So we're already seeing that come down. So it has affected us a little bit. It affected the margins a little bit. We've since corrected that. We've adjusted our prices. So I think we've worked our way through that for sure. It's much better now than it was, say, a year ago.
Yeah. And there's so much concern about potential recession. Certainly there's slowdowns in certain parts of Europe and others for different reasons. But how do you see sort of the potential recession affecting you guys?
Yeah, I don't think it will affect us. I mean, I hope it won't affect us, but for a couple of reasons, it gives me a lot of confidence. Number one, as long as energy prices don't come down, they're going to still be keen to reduce their costs, even more so perhaps in a recession. And second of all, the majority of our business is food and beverage, pharmaceutical, hospitals, which are not cyclical. I think there was either 2 or 3 brewers, one, beverage company, and one snack food company on our list of projects. Well, the pandemic was great for beer and chips. So,
exactly. All the things that people run to when there's a recession.
So I think we're probably in pretty good shape, recession or not.
Yeah, no, it sounds like it. And then just lastly, sort of, is there anything else that sort of keeps you up at night, or what, if anything, does keep you up at night?
These days, not much. I mean, it's always a challenge, and you talked a little bit about it, Paul. Our what limits our growth is people, because we're a technology business. And so it's always a little bit of a challenge to find good people, because there's been a lot of salary inflation. I looked at some data a few months ago, and it had the listing of the different types of salaries and what the salary inflation had been over the last year. Right at the top of the list, was engineers and technical people. Right. So that's our bread and butter. So finding good people and being able to retain good people is probably still a challenge for us. That's what we try. We work very hard at. I'm proud to say we haven't lost anybody during the recession. So during the pandemic, at least, so, but that's the challenge to growth for sure.
Yeah, I could see that. Last question is sort of a crystal ball question. Where do you see the business in 5 years? Like what does it look like? I mean, you can't really give guidance and something like that, but how do you see the business in 5 years?
Yeah, I think we want to get back to the levels of revenue and profitability we were. We think we can do that in the short term, and then continue growing at the historical rates, and then likely add to the business either by acquisition or other growth in Europe. We have what we believe we have all the technologies we need. The last 2 acquisitions we did were technology based. What would really be interested in next would be distribution. So somebody that's doing something similar to us in a market we're not in. and that would be Europe. So it's just being much bigger. I think we just want to keep growing the business.
Yeah. No, good. I mean, this has been great. We've covered a lot of things, but Bill, is there anything else you want to say? A last remark or parting message you want to make sure everybody walks with?
Yeah, our investors, our website is right there, and don't hesitate to reach out and contact us if you have any questions or other interest in the company. Be happy to talk to you.
Fantastic.
So it's exciting times, and we're really looking forward to the next few years. That's for sure.
Well, listen, congratulations on the last 6 months. So clearly things are starting to really look up for you guys, and you've weathered a pretty rough storm. A lot of other companies weren't able to weather so well. And it looks like you're in a pretty strong direction upwards from here. So congratulations on that. We've been speaking with CEO Bill Crossland of Thermal Energy International, TMG on the Venture Exchange. Bill, as always, thanks for connecting with us today.
Yeah, thank you so much for having me, Paul. Take care.
Take care.